Hi, this is Alan Madden. Thank you for attending today's presentation. The subject matter is new changes to small business tax. Could we please move to the agenda? My name is Alan Madden, for those of you who don't know me, and I am a chartered accountant and CPA practicing in the Greater Toronto Area. I work with many small to mid-sized business owners with tax return preparation services and tax planning services. Today, we will cover the government's changes specifically to income sprinkling for small businesses, family trusts, passive investment income, and then we will turn it over to you for your questions, followed by my answers. Let's please proceed to the next slide. Income sprinkling. Let's get some context here. Income sprinkling is a strategy used to distribute income among family members of a family business. When income is sprinkled among many family members, the overall tax burden decreases. Let's look at a practical example to demonstrate this concept. Okay. In the chart, you will see a total dividend is paid from a family business to four shareholders: father, mother, adult child 1, and adult child 2, totaling $360,000. The father and mother each receive a dividend of $100,000, and the adult children receive $80,000 of dividends each. In doing so, we have split income among four different family members. So the total tax burden is reduced to only $46,000 on $360,000 of total dividend payments. Not bad. The government finds this offensive, and they are putting in place new rules to stop or significantly make it harder to income split with family members of a Canadian private corporation. Under the new rules, let's assume that the total dividend of $360,000 is only paid to the father, who is the principal owner of the business in our example. He will pay taxes of $126,000. That's an increase of almost $80,000 under the income sprinkling method. So you can see why many business owners are outraged at the prevention of income sprinkling. Let's look at this in further detail, shall we? There are restrictions on dividends paid to family members. That doesn't mean that dividends can no longer be paid to family members of a small business in Canada. They can, but there are some rules that we need to follow. First, dividends paid to family members must be reasonable based on the work they perform. Let's look at an example. Let's assume that you are a principal business owner and you direct your corporation to pay an annual dividend of $100,000 to your 18-year-old son or daughter for data entry work. Clearly, that is not reasonable. So under the new rules, a dividend payment of such a magnitude to a family member for clerical work would be restricted. I suggest that if you are to pay a dividend to a family member who is working in the business, make sure that dividend is reasonable in amount. In addition, prepare timesheets to evidence the work that that family member has performed in the week, as well as a job description. You don't have to provide these timesheets or the job description to the Canada Revenue Agency, but you should keep them on file should you be asked to produce them in the event of an audit. The government has restricted dividends further by age category. 18 to 24-year-olds can receive dividends if they are actively engaged in the business on a regular and continuous basis. That means you can't pay a dividend to an 18 or 24-year-old who is working part-time. For those 25 years and older, you can pay a dividend to them, a reasonable amount that is, so long as they're involved in the business. Part-time work is okay. The second type of restriction that is placed on dividend payments has to do with investment dollars. Dividends paid to family members must be reasonable based on the amount or amounts that family member has invested in the business. For example, assume you have an adult child who subscribed for shares in your company for only $100. His total investment is $100 in the family business. So it would be unreasonable for him to receive a dividend of $10,000, for example, based on a measly $100 investment. The government has placed restrictions on the rate of return that a family member can receive on their investment in a business. The rate of return is represented by a dividend payment. For those 18 to 24 years of age, the rate of return percentage is determined by the CRA on the amount invested. For those 25 years and older, the rate of return is based on market risk. For example, a startup could have a higher dividend payment than a established business because there's more risk with the startup. Now, I want you to understand, please, that this is an or condition. What I mean to say is that dividends can be paid to family members if they work in the business, so long as the amount of the dividend is reasonable, or dividends can be paid to a family member who is an investor in the business, so long as the dividend paid is reasonable based on their investment amount. Okay. Let's go to the next slide, please. One more slide over. Okay. The October 16th update. There was a lot of backlash in the business community about restricting dividends paid to family members for obvious reasons. So the government has said that they're going to come up with a new framework for measuring what's reasonable when paying dividends to family members. It's supposedly going to be less restrictive. They hope to announce more details come November, but it's supposedly based on 4 principles: labor contributions made by family members, capital or equity contributions to the business, sharing the financial risks of the business, and past contributions in respect of previous labor, capital, or risks. Right now, that's a bit ambiguous. So as we hear more from the government, I will share that information with you on the loosened dividend restrictions. Can we go to the next slide, please? Tax on split income. So what happens if you pay a dividend to a family member in excess of a reasonable amount? What's the consequence? Well, let's look at an example. John receives a salary of $50,000 for working for his mother's company in Canada. He also receives a corporate dividend from Mom Inc. at Christmas, nice mom, for $30,000, unrelated to his work. Well, the $30,000 is considered split income, and there's a tax on that of 45%. So 45% of $30,000 results in $13,500 of tax on split income. That's what John will pay. So you can see what the government is trying to do is impose a really high rate of tax on unreasonable dividends paid to family members, as to discourage you, the principal business owner, from income sprinkling. Could we go to the next slide, please? Now we're done with income sprinkling. Let's look at the government's changes to family trusts. This made me really mad because I have a family trust too, as do many of my clients. What they had proposed is to restrict the multiplication of the lifetime capital gains exemption. For those of you who don't know what the lifetime capital gains exemption is, let me explain. In Canada, when the shares of a private corporation are sold, the shareholders can claim a exemption of up to $830,000 of gain, so that the first $830,000 of gain will not be taxed per shareholder. This also extends to family trusts. Let's look at the diagram. I think it's a very good way to explain this. In this example, there's a family trust that is the sole shareholder of Yum Inc. Sounds good. Jim is the trustee. He runs the business. And he has three lovely adult daughters, daughter one, daughter two, and daughter three, who are beneficiaries of the trust. Jim receives an offer to sell Yum Inc. for $2,490,000. He can't refuse it. So the family trust, who is the owner of Yum Inc., sells all of Yum Inc.'s shares to Cupcake Inc. for $2,490,000. The family trust then disperses the proceeds of $2,490,000 equally among the three adult beneficiaries, who are Jim's daughters. Each daughter receives a nice check of $830,000. How much tax will they pay on that? Nothing, because they are claiming the lifetime capital gains exemption each on their personal tax return for $830,000. The government found this grossly offensive. And if you step back, hey, that's not a bad deal. You sold a business for $2.5 million and you didn't pay a single cent in tax. That's a pretty good, favorable tax regime. Okay. Because there was so much backlash, let's go to the next slide, please. Because there was so much backlash by the business community, Jim Murneau, the finance minister, surprisingly backed off and is now allowing, as is the current regime is, beneficiaries of family trusts to claim the lifetime capital gains exemption. So thankfully, for those of you who have family trusts, your children and other beneficiaries of your trusts can still claim the lifetime capital gains exemption when the business is eventually sold. However, some bad news. The government did restrict dividends paid from trusts to beneficiaries of those trusts if they were family members. So let's look at an example. We'll continue with Yum Inc. Yum Inc. Pays an annual dividend to the family trust. And then the family trust then disperses that dividend to each daughter. So each daughter who's a beneficiary of the trust receives a dividend of $50,000. Okay, they'd pay very little tax on that in the current regime, maybe a couple $1,000s. However, under the new tax regime effective January 1st, 2018, they will pay tax on split income of 45% on the $50,000 dividend received. That means each daughter will pay $22,500 in income tax. As you can see, the government is stopping business owners from using family trusts to income sprinkle with adult beneficiaries. Let's move to the next slide, please. Passive investment income. I think this is one of the most controversial proposals that the government has imposed. It's ludicrous, and I encourage you to please speak with your local MP and shout as loud as you can about this. It's just bad. Let me explain, please. Canadian business owners save money within their corporate bank accounts in order to avoid paying high personal tax. I do that. I'm sure you do that too. The government is upset. This is dead money, according to them, that's not creating jobs. So to discourage corporations from hoarding their money, the government will now tax investment income at a higher rate of up to 73%. Let's just step back. You may have bonds in your business, mutual funds, real estate investments that are held by your corporation. What I'm telling you now is that the effective personal and corporate tax rate combined is almost 73% on those investment dollars earned, the investment income earned. Who in their right mind would now make investments through a Canadian private corporation just to give 73% of it away to the taxman? I'm not. Let's look at an example, please. Prepared a chart. Okay, there's three columns: corporate tax, personal tax, and total tax. And I'm trying to illustrate the concept here of the high rate of tax on passive investment income. So the business receives passive investment income, rents, royalties, etc., of $100,000. The corporate tax rate is 50% or $50,000. And so that means the company has $50,000 of after-tax cash from its investment income to disperse to shareholders. Let's assume there's a single shareholder. So the company disperses the $50,000 as a dividend check to the sole shareholder who happens to be in the highest tax bracket. He will pay tax, or she will pay tax, at a rate of 45%. That's $22,500 in personal tax. So if we add the corporate tax of $50,000 plus the personal tax of $22,500, collectively the corporation and you as the shareholder have paid $72,500 in tax on $100,000 of investment income. Okay? Clearly there was a lot of backlash. Let's move to the next slide, please. Clearly there was a lot of backlash. People were angry. So they offered a small carrot. And the government has now said, listen, we're not going to apply these rules to the first $50,000 of investment income earned by a Canadian private corporation each year. Anything over and above $50,000, the new rules apply. In other words, the first $50,000 of investment income will be taxed at 50%, which is the rate now. Anything over and above $50,000 each year will be taxed at collectively, personal and corporate, 73%. Okay. Food for thought. Now, one more change to passive investment income. Let's go to the next slide, please. And this is shocked. Capital gains. Let me explain. Businesses have investments. Corporations have investments. They may own stocks, mutual funds, real estate, or other types of property. When those investments are sold for a profit, it's called a capital gain. Okay, capital gains are half taxable to a corporation. The corporate tax rate on capital gains is 50%. Okay, 1/2 of the capital gain is added to the capital dividend account. What the government is proposing to do is eliminate the capital dividend account increase on the sale of investments. I think it's better illustrated by an example. Let's look at the existing rules. We have 3 columns again: corporate tax, personal tax, and total tax. Okay, there's a lot of numbers here, but I just want you to pay attention to the bold parts. This corporation has a gross gain of $100,000, okay, from the sale of some investments. The net corporate tax paid in bold is $9,667. Let's assume that the corporation has dispersed all of the after-tax proceeds from the corporation to the individual shareholder, and the individual shareholder happens to be in the highest bracket. Okay, so the individual shareholder will only pay $16,795 on the money that he or she receives. It's a dividend. The total burden comes to $26,462. Okay, let's look at the next slide. Exact same scenario as what I just explained to you. $100,000 gain, corporation pays $9,667, but now look, the personal tax has jumped up. It's $37,615. Why? Well, it's because the dividend paid to the shareholder is now fully taxable, $90,333. This is because the government is proposing to eliminate the capital dividend account. So the total burden between personal and corporate comes to $47,000. Can you go to the previous slide, please? Let's look at the personal column. You'll see that in the personal column, there's 2 types of dividends paid. One is a taxable dividend, $40,000. The other is a non-taxable dividend from the capital dividend account, $50,000. That $50,000 represents 1/2 of the capital gain, and it can be paid on a tax-free basis to the shareholder. It's called a capital dividend. Okay, and let's look at the next slide again. Oops, the $50,000 is crossed out in this slide. Okay, you can no longer receive a capital dividend from the capital dividend account in this example. So that's why the whole dividend becomes taxable. And you're collectively paying between yourself and the corporation $47,000 of tax. Now, this has a lot of people worried. Imagine you have accrued gains right now in your investments. What do? Do you sell them now and realize the gain? Uh, or do you just wait? Now, the government has said that they are going to grandfather existing investments. What that means is that any investments that you currently have won't be subject to the new rules with respect to capital gains tax and investment income tax, which is good. But what they weren't clear on is that what happens if the property is sold on January 1st, 2018 or after? Does that mean that the capital dividend account will no longer be available? They haven't been very clear on that. And that's why there's a lot of uncertainty. And we hope to get a further update come November on the capital gains tax with respect to investments currently held by businesses but sold after 2017. Let's move to the next slide. I think that concludes our presentation. Yeah, we're open to questions and answers, please. So can they individually speak? Do they unmute their phone, or how can they ask the question, please? Yep.
Hi, I have.
Okay, so everyone's unmuted now, and they can just speak out loud, right? Okay, any questions?
Yes, my name is Andrew Willis.
Sorry to interrupt you. Could you turn up the volume? I can barely hear the fellow. Or maybe it's on his end, I'm not sure.
Sorry, what was your name?
I think so.
Hi.
No, it says Jim, Talking Jim Mickle. It's Jim. Unmute Jim. Okay, Jim, go ahead, please. Hi, Jim, you there? I think it might be a bad connection. Sorry, Jim, maybe you could email me your question afterwards. Put in the chat window and I'll answer. You can type it. Andrew is speaking. Yeah.
Hi.
Yeah, I can barely hear you. Yeah.
Hi. For all those that can hear me.
Sorry, you know what? I think, guys, can you just type? Maybe because there's so many people. Could you type, please, your question in the chat window? I'll read it out loud for everyone's benefit.
Okay, I'm just trying to find out where the chat window is. I don't know if I can even find.
Could you mute everyone again, please? Okay, so type your question in the window, and please, I'll answer it. So I know Andrew had a question and Jim had a question. Just waiting for you to type it.
We have some callers. Should we unmute them? Because they won't be able to type in the chat.
No, let's not unmute, because then it creates background interference for everyone, is what they're saying. No questions? Okay, I think it should work now. Could you unmute? Okay, here it goes. Awesome presentation. Thank you. How does the new rules apply to holding companies? Good question. Drazen, yes, the new rules do apply to holding companies. What that means is that the income sprinkling rules, the tax on passive investment income, will still apply to holding companies that own real estate or other investments. Any other questions that you'd like to type in, please? What I'd suggest is my email is also on the website. It's amadden@maddenca.com. What I would suggest that you do is please send me an email. There's one more question here. If you are starting a new business and investment is coming from personal funds, can you circumvent income and dividend sharing by giving the funds first to family and then loaning it to the company? No, there'll be an anti-avoidance rule that will prevent that. Good thought, but that strategy won't work. Another question is, if we have an existing money and buy stock today, will it be under the old or new rules? So existing investments will be grandfathered. It will be under the old rules. What's very unclear is that if that stock is sold after 2017, will the capital dividend account be increased or eliminated? And that's a big question that I have, and I'm waiting for the November update. Another question is, if I have some dead money, working capital, how will it be affected? Well, if the dead money isn't making any investment income, you're not impacted by the higher tax on investment income. You'll be probably prevented from income sprinkling that dead money to shareholders of your business who are family members. The next question is, what is the exact date that the rules come into effect? The rules come into effect on January 1st, 2018. Okay. The next question is, due to the high dividend tax rate, does it make more sense to issue bonuses instead? Bonuses and salaries still have to be reasonable. The reasonableness test has always existed for them. So I would still continue to pay dividends to family members so long as they work in the business and the amount paid to them is reasonable. One question is, I was late to this. Are the Liberals getting rid of the lifetime capital gains exemption? No, they are not getting rid of the lifetime capital gains exemption. They had initially proposed to, but as of their October 16th update, they said that the lifetime capital gains exemption will stay intact as is. The other question is, I have a corp. I work with my wife, and we have our different services. For example, I'm into software consulting, and my wife is into multimedia stuff. But we negotiate in US dollars and then convert into Canadian. Will the new rules have any impact? We don't have any investments. Money in our business account, dead money. What I would say is that dividends paid to yourself and your wife have to be reasonable based on the work you perform. So if one is doing a lot more work in the business and generating most of the income, they can receive a much higher dividend than the one that is maybe only making a small portion of the total revenue. In terms of the dead money, if you're not investing that dead money, then you won't be impacted by the higher rate of tax on passive investment income. The next question is there any possibility that the introduction date will be moved back from January 1st, 2018? The answer is it's possible. I'm waiting for the November update from the Minister of Finance, as you all are. Let's see what they say. Another question is, if a business is inherited, how will that impact the tax payable? Maybe you could email me separately. I think I need a little more information about the inheritance and some more details. Any other questions? Okay, the next question is, what measures as a business owner do we need to put in place before the new rules come into place? Great question. The first thing that you should do is that if you are paying dividends to family members, make sure that the family members have a job description prepared by the business for them. That job description should be kept on file. In addition, the family members who are receiving dividends should prepare timesheets every week to document the hours they worked and what they did. This is so you can justify the dividend paid to him or her. The next question, with these changes, does it still make sense to take more income via dividend or more via payroll? So it doesn't make a difference really. The reason being is that both dividends and salary follow the same reasonableness test. What that means is that dividends or salary paid to a family member have to be reasonable based on the work they performed. Okay, but I still prefer dividends because they don't attract Canada Pension Plan premiums. So that's a savings of 9.9%. Plus, you don't have to worry about payroll tax. Next question. Do you think that using a holding corporation as a retirement strategy is not advisable anymore? What are the alternatives? I know that's a tough one. It is advisable. Remember that the first $50,000 of investment income earned by a Canadian private corporation is not subject to a higher rate of tax per the new rules. So if you just assume a 5% rate of return, that means you could invest up to $1 million through your corporation and earn 5% or $50,000 per annum without having to worry about the impact on the new rules. Question, can we get a copy of the presentation? Yes, we will circulate the presentation plus a link for the webinar. We have recorded it. Yeah, I want to buy a house and need to show a decent income to get a decent mortgage, but dividends aren't considered. No, dividends are considered. I think that's a common misunderstanding. If you could look at line 150 of your notice of assessment, dividends are actually included in your total income. So when I apply for a mortgage, I provide my notice of assessment, and line 150, which represents my total income, includes dividends. Next question. I have a corporation. Sorry, was it this one here? Should we invest all the spare cash in our business account before January 1st, 2018? If you have existing cash, I would keep it in the business. I wouldn't be in a hurry to dividend out all of the cash to myself. I mean, that would just attract personal tax. I would just be very careful in what I invest in. I would make sure I invest in passive investments so long as they don't generate more than $50,000 of passive investment income. I'd consider maybe investing in projects that will generate business income, such as real estate flips, land development. Those are considered active business income and are not subject to the passive investment income rules. Next question. With companies that have branches abroad, USA and Mexico, double taxation, can I use that to my advantage? You can. So there are tax treaties between Canada and other countries that do prevent double taxation, but that won't help you get around the income sprinkling rules for paying dividends to family members, and that won't help you get around the rules on passive investment income. What you could consider doing is that if you have a subsidiary corporation in Mexico or somewhere else that's in a lower tax jurisdiction, consider making your investments in that country. Now, we do have something called FAPI, foreign accrual property income, which tries to circumvent those rules by having Canadians invest in low tax jurisdictions, but maybe you can email me separately and I can go through that in more detail. Okay. We'll end it there. I'll just take this last question. Can you give a few more examples of what passive investments are versus active investments? And then any further questions you have, please email me. I promise I will answer you. A passive investment is something that generates passive income like rents, royalties, dividends, and interest. An active investment is something that generates business income. Examples include a factory, a software business. It could include flipping houses or real estate development where you construct the property and sell it. Okay, thank you everyone for attending today's presentation. I really appreciate it. I will circulate the slides to all the attendees and provide a link of the recorded presentation. Thanks again so much and have a wonderful day and wonderful weekend. Thank you.